Asset correlation during market corrections. I totally feel like this piece is unnecessary because there are never market corrections. I mean,
I've heard of them.
I've heard of them, right? I've heard of them too. They used to happen back in the like 80s and 90s and 2000s, but we haven't had a market correction for so long. I forgot what one is like.
Yeah.
So, but this is a piece called...
If a correction were to happen.
Yes. We often say that equities tend to move in the same direction during market corrections, implying that the correlation between assets strengthens when the market declines. But does historical data support this observation? Is a question. What do you think?
I'm going to wait for the data.
I know, but this is not a show about waiting for the data. This is a show about
guessing and seeing if the data actually confirms.
And then trying to prove you wrong and saying,
I think,
dummy.
Yeah. So when the market declines, yes, I think everything goes down. In other words, there are no shining lights in a crash. So in a correction, when the market is selling off and people are pulling money out of the market and in everything converting into cash, that, yeah, I would say that the correlation increases on down moves more than it is on up moves.
That's what we've been saying all along for years.
Okay, well, I didn't know you've been saying that. I mean,
we've been saying it on this network forever. On the way down, everything goes to one. On the way up,
common knowledge. But again, we could be wrong.
On the way up, let's think of it like a breaststroke. On the way up,
yeah.
On the way down,
wax on, wax off.
That's right. For example, the long-term average correlation between NVIDIA and the SPY is 0.56, which is considered a moderate positive correlation. Do we see a higher correlation reading when the broad market panics? And that is a question.
So 56 correlation is the benchmark, okay?
Well, yeah.
Well, no, but that's to compare it to.
A simplified way to find to find the market correction is to examine the VIX level. If our assumption was true, we would see an increased positive correlation between NVIDIA SPY when the VIX is significantly higher. I wonder if NVIDIA just being NVIDIA now is so much different, but let's see. Yes. Let's go to the next slide. So we do observe an increase in correlation between the SPY and NVIDIA during some of the largest downside movements of the past decade. And you can see here, obviously, again, I'm not sure NVIDIA is the greatest judge of this, only because NVIDIA has been a different animal in the last year or so. But
it's a good test for the premise.
It's a good test for the premise.
If NVIDIA shows any of this, it would suggest it's true for everything. So I want to make sure people understand what they're looking at here. Down below is the level of the VIX. The red is the actual VIX. The green line is the correlation between the SPY and NVIDIA. It's not the price of the SPY or NVIDIA's price. So it's VIX is in the red, green is the correlation. The peaks of the correlation tend to happen during peaks of the VIX. So in other words, when the VIX goes up, the correlations are a little bit higher. That's not in every case, because you see some, smaller spikes in VIX and the correlation doesn't necessarily increase. But it is true. The other important thing to realize is that we're not doing the standard sort of Yahoo Finance idea of market corrections down 10%, blah, blah, blah. No. We look at the actual VIX. We look for confirmation in the VIX. When the VIX spikes up after the market sells off, that is a good confirmation of a correction. So in this case, not in every time, but in many times we see the spikes in the correlation occur in relatively high VIX. So yes, in this example,
let's go to the next slide.
On the downside, the correlation increases.
We also found that the average correlation number also increases when the testing VIX level is higher. This confirms that these two assets have a tendency to move together when the VIX is greater. So you can see here NVIDIA SPY correlation and goes up and up and up as the VIX level goes higher and higher, even though there's not that many VIX levels.
I've never seen this before. This is very cool.
Yeah, well, we're only doing NVIDIA SPY here, but yes. Next, we expand the study to multiple random underlyings across different sectors. So we looked at Love, EEM, Apple, XLE, and Costco. Okay, just
Can't get more random than that.
that is very random. And here we go. We're going to expand the VIX levels from 20% to 30% to 40%. And you can see in every one of these cases, the correlation to the SPY moves significantly higher.
No matter what the business is. So you think it's a consumer non-durable, it's an industrial, it's a biotech, blah, blah, blah. It doesn't matter.
When we go up, correlations go down and everything spreads out. When we go down, the correlations all contract towards closest to 1.
Yep.
And it's just the nature of sell everything versus buy whatever you like.
Just get me out right.
Yeah. Get me out is very different than a stock picker's market.
Yeah.
This is a stock picker's market. People are buying they're buying Nvidia, they're selling Apple.
Because they figure no matter what stock they pick, it's going to be right. So sure, I'll pick that one or that one. Anyway, this is a very interesting slide. I've never seen this data before. It just confirms our belief.
Yeah, I mean,
this is very cool.
Yeah. It's an aggressive approach. Look at this Bitcoin right now. I'm just taking a look, but it's up 5,500, which has pushed Coinbase up $24.
Yikes.
$24 to almost back to a new high. So assets tend to move in the same direction when the market is falling significantly. Thus, portfolio diversification and hedging might become less effective when volatility is elevated. Reducing portfolio allocation can be an effective strategy to reduce potential risks. So again, we learned here, assets move in the same direction when the market's falling. Everything goes to 1.
Yep.
The general practice should be always to diversify, but you diversify by strategy, diversify by duration, diversify by underlying. But still, as volatility moves higher, it's painful no matter what.
Yeah.
There's nothing you can do because the market's in crash mode at that point.
Yeah.
Or it's heading down. How do you adjust for that? You just get smaller.
Stay small.
Stay small, get smaller.